Welcome to Talk Tickers. Today, we're digging into a massive shift happening deep inside the plumbing of the global markets, the move to T+1 settlement. Now, I know that sounds super technical, but trust me, its impact is creating waves for finance all across the globe.
So, let's start with a big question to get our heads around this. What really happens when you take a full 24 hours out of the time it takes to finalize a trade? It might not sound like a lot, but in a system that's built on precision and timing, well, it turns everything into a massive race against the clock.
And that race leads us right to the first major hurdle, what we're calling the T+1 conundrum. Specifically, the incredible pressure this puts on foreign exchange markets. For international investors, this is a brand new, high-stakes problem.
Okay, so here's the core of the issue. Imagine an investor in London or Tokyo buys a US stock. To pay for it, they need US dollars, right? Well, under the old T+2 system, they had 2 whole days to get that currency exchange sorted. Now, they have just 1. That window to get the dollars they need has been slashed in half, creating a huge operational squeeze.
And we are not talking about a small corner of the market here. In 2022, foreign investors held almost $25 trillion in U.S. securities. Every single one of those holdings is now caught up in this new, faster timeline, which just amplifies the global shockwaves of this change.
To really get why this is such a big deal, we need to take a quick step back. Let's talk about what settlement actually is, and how we even got here. It's a fascinating story, really, about the endless quest for more speed and less risk.
Put simply, settlement is the final official handshake of a trade. It's the moment the stock legally becomes yours and the cash is officially in the seller's account. Until settlement happens, a trade is really just a promise, an IOU. What's so interesting is how we got here. This has been a constant drive for speed. Back in the 1700s, it took 14 days to settle a trade, literally the time it took to move money by horse and ship. By the 60s, it was down to 5 days, then 3 days after the '87 market crash, and then down to 2 days in 2017. Every single step was about cutting down risk. See, the longer a trade is unsettled, the more risk there is that someone won't pay up. And now, in 2024, the US, Canada, and Mexico have made the huge leap to just 1 day.
So this historic race to reduce risk has now created a very modern race against time, especially when you throw global time zones in a mix. Shaving off 1 day in North America means the rest of the world has to scramble to keep up. You see, the US markets are so deeply woven into the global financial fabric that when they change their internal plumbing, everyone else has to re-engineer their own systems. A decision made in the US creates massive operational headaches in Frankfurt, London, and Tokyo. And this really shows you just how tight the squeeze is. If you're an investor in Europe, you now have just a few hours after your own market closes to get everything done for your US trades. And if you're in Asia, it's even tougher. Your business day might be completely over before the US trade even happens. This has created what people are calling a golden hour, a frantic rush for US dollars around 5 p.m. Eastern Time. The pressure is so real that some firms are actually thinking about moving their entire currency trading teams to the US just to manage. And this quote from a BNY Mellon exec really hits the nail on the head. The old way of doing things just doesn't work anymore. Those informal credit lines, the safety nets that investors used to count on from their banks, they're no longer a given. It's forcing everyone to find new, more reliable solutions, and fast. And this urgent search for new solutions is creating ripple effects that go way beyond just currency markets. They're starting to affect some of the most popular and complex products out there, like ETFs.
This chart just hammers home the sheer scale of what we're talking about. Foreign investment in the U.S. has absolutely ballooned over the years. So now, any disruption in how trades get settled has these massive, cascading consequences for a huge amount of money.
And ETFs are a perfect example of these consequences. In the primary market, that's where new ETF shares are actually created, there's now a serious funding gap. The ETF itself settles in 1 day, but the international stocks it holds might still settle in 2 days. The whole model is broken. Then, in the secondary market, where you and I trade ETFs, it can mean higher costs for all of us. The market makers are facing more risk, so they pass those costs on to investors through wider spreads between the buy and sell price.
Look, when you speed everything up this much, you just flat out increase the chances of something going wrong. We're talking about a higher risk of failed settlements, where a trade just fails. Big institutional investors who used to have all night to get their books in order now have to do it in just a few hours. And all this pressure puts a giant spotlight on any process that's still done by hand. Automation is no longer a luxury, it's an absolute necessity.
So the big question is, How is the financial world actually adapting to this new, much faster reality? This isn't about just tweaking a few things here and there. We're watching a fundamental overhaul of how global trading operations get done.
The industry is really hitting this with a three-pronged attack. First, firms are taking a hard look at all their funding and credit lines to make sure the cash is there when they need it. Second, like we said, they are automating everything they possibly can. And third, they're adopting totally new ways of handling foreign exchange, like pre-funding, which basically means keeping cash in different currencies on hand, or just doing the currency trade at the exact same moment as the stock trade.
And you can see how the strategies are shaking out in this survey. It's pretty interesting. About a third of firms are planning to do the currency and stock trade at the same time. A quarter are going to rely on pre-funding. The rest are split between diving into that chaotic end-of-day window or trying to pull off the currency trade on the settlement day itself, which is a very, very tight deadline.
So what's the bottom line here? Well, the move to T+1 is a massive trade-off. On one hand, it absolutely makes the financial system stronger by cutting a full day of risk out of every single transaction. But on the other hand, it's creating this intense operational pressure, especially for international players, and that could lead to higher costs and more failed trades, at least in the short term. It's a global race to adapt, and it begs a much bigger question. Now that the industry has proved it can move this fast, is near-instant T+0 settlement the next logical step? T+1 might not be the end of this story, but just another chapter in the relentless march towards speed.
And as always, this is not financial advice.